Ever felt like picking an ETF is like standing in front of a 200-item restaurant menu? You know you need something to eat, but you get paralyzed by the choices. It's the same with investing. There are more than 3,000 ETFs in the US market today, and that number alone is enough to overwhelm most beginners. That's exactly why millions of new investors hesitate or never even start. In this video, I'll show you how just 5 Schwab ETFs can form a compact system you can actually use today to grow wealth without sifting through thousands of funds. So why is it that more choice often makes investing harder instead of easier? When it comes to ETFs, the sheer number of options can quietly turn into your biggest obstacle. What should feel like flexibility often becomes confusion. More choices don't always lead to better outcomes. In fact, they often push investors into hesitation, second-guessing, and in many cases, doing nothing at all. Psychologists call this analysis paralysis, and it shows up most clearly when you're faced with thousands of similar options that all claim to be the best. ETFs were originally designed to simplify investing. Instead of researching dozens of individual companies, you could buy into one fund and instantly own a diversified basket of stocks. That was the beauty of the idea. It made the playing field accessible for regular investors. But as the number of funds exploded, the irony became impossible to ignore. What was supposed to make things simpler gradually became more complex. With every new specialized ETF added to the market, another layer of uncertainty is introduced, leaving beginners unsure where to start. The problem of too much choice isn't unique to investing. You've probably felt it in everyday life. Picture standing in front of a grocery shelf with endless flavors of the same product, or scrolling through streaming apps until you're too tired to pick anything. The reality is that human satisfaction drops when choices multiply. Regret goes up, confidence goes down, and the fear of making the wrong decision keeps you stuck. Now imagine applying that same dynamic to investing. In the US today, there are well over 3,000 ETFs available. That's like being dropped into a warehouse full of thousands of aisles when all you really need is a small handful of essentials. Without clear boundaries, most people either walk away without buying anything or grab something random just to get out of the overwhelm. For new investors, that hesitation can carry a heavy price because every month and year of inaction is lost compounding time. Think for a moment about someone who downloads a brokerage app for the first time. They start excited, browse through ETF options, tell themselves they'll research a little more, and before they know it, years have gone by with their money sitting idle. Studies confirm what seasoned investors already know. Time in the market is worth more than endlessly searching for the perfect pick. Starting imperfectly beats not starting at all because compounding rewards consistency, not hesitation. This is where the real insight lies. More variety doesn't guarantee success, it often guarantees delay. The solution isn't to chase every possible option, but to set clear limits. When you intentionally reduce choices, your confidence rises. You don't need to constantly compare every fund ever created. Instead, you can rely on a streamlined set of tools that cover the essentials and keep you moving forward. That's what investing is really about: consistent, long-term action, not constant second-guessing. So here's the principle to carry forward. More is not always better. Too many choices can freeze you, waste valuable time, and lead to missed opportunities. The investors who simplify their menu of options often build more wealth than those who spend years scrolling through an endless buffet of funds. The question then is not whether variety exists, but how few tools you actually need to cover every major investing need. Imagine if it were possible to build a complete portfolio with fewer funds than you have fingers on one hand. To solve that problem of overwhelming choice, we'll narrow it down to what I call the 5 ETF toolkit. It's a compact lineup built from Schwab funds that trims away the clutter and focuses on the essentials. Instead of scattering your money across dozens of overlapping products, you can get broad diversification, income, growth, and stability with just 5 carefully chosen ETFs. The purpose behind this design is balance. Each fund in the set fills one specific role. Together they form a foundation that adapts to different markets and life stages, yet remains simple enough for almost anyone to follow without endless research. Let's take a closer look at how each piece works. First is SCHD, the Dividend Anchor. This fund tracks the Dow Jones U.S. Dividend 100 Index, focusing on companies that screen well for fundamentals like cash flow to debt, return on equity, and consistent dividend growth. SCHD currently carries a dividend yield of about 3.92% and does this with an expense ratio of just 0.06%. That combination of reliable income and low cost is why it's often seen as a go-to option for building steady cash flow. It puts quality first, which helps investors see dividends not as a side effect, but as a deliberate strategy for income and long-term stability. Next, SCHG, the Growth Engine. It follows the Dow Jones U.S. Large Cap Growth Index and leans hard into innovative, high-growth companies. Over the past decade, it's delivered a compound annual growth rate of 15.89%. But the trade-off shows clearly. It's heavily concentrated, with nearly half its weight in technology firms, and the top 10 holdings representing more than 55% of assets. That fueled its upside, but it also meant enduring steep falls, like a negative 31.80% drawdown in 2022. SCHG is the component that injects upside and volatility, a reminder that growth potential always comes with more risk. Then comes SCHB, the Broad Market Foundation. This fund tracks roughly 2,500 U.S. companies through a total market index, giving exposure that stretches from the largest household names down to smaller cap firms. With an expense ratio of only 0.03% and a 10-year CAGR of 12.16%, it's both inexpensive and effective. Because it's market cap weighted, SCHB naturally leans toward the biggest sectors, with over 30% in information technology alone. Even so, it's a bedrock fund, widely diversified and ideal as the core holding for long-term investors. Outside the U.S., SCHY adds international reach. Modeled after SCHD, it tracks the Dow Jones International Dividend 100 Index and focuses on dividend-paying companies abroad. Launched in 2021, it has a short track record and hasn't proven itself over a full market cycle yet. It has very little exposure to technology, about 2.38%, and emphasizes companies across Europe, Asia, and other markets. In 2022, it faced a sharp drawdown of negative 21.60%, showing the risks of newer funds, but also the benefits of diversification beyond the American market. Finally, SCHZ provides stability from the bond side. It tracks the Bloomberg U.S. Aggregate Bond Index, holding thousands of investment-grade bonds across government, corporate, and mortgage sectors. About 71% of these holdings are rated AA or higher, and the fund charges a very low 0.03% expense ratio. Bonds like those in SCHZ can steady a portfolio when stocks swing wildly. Though rising interest rates recently hurt performance, its 5-year CAGR currently sits at minus 0.97%. The key here is ballast. While rates shape short-term results, SCHZ gives protection and reduces volatility in a long-term strategy. Put together, SCHD delivers income, SCHG drives growth, SCHB anchors the core market exposure, SCHY expands internationally, and SCHZ adds much-needed stability. With these 5 ETFs, you can cover thousands of securities and all the major levers that matter in investing. The real power lies in how flexible this toolkit becomes. You can tilt toward growth while you're young, lean on income as you near retirement, or adjust gradually in between, all without adding dozens of new funds. And that brings us to a practical question. How does this toolkit adapt as your needs change over a lifetime? Portfolios aren't static. They're meant to adjust as your priorities shift over time. That's the strength of the 5 ETF toolkit. It gives you one consistent foundation that you can reshape as your life moves from growth to balance to income. Instead of swapping products every decade, you're simply tuning the mix to fit your stage of life. Here are the 3 practical allocations that use only these 5 ETFs. For a young investor in their 20s, the focus is on growth. One approach is 50% SCHG, 30% SCHB, and 20% SCHY. That's a 100% stock allocation, no bonds at all. The reason is simple. You have time to ride out volatility. SCHG's historical 10-year CAGR of 15.89% illustrates how powerful long compounding can be. But remember, it also dropped around minus 31.8% in 2022. That's the price of growth exposure, and it underscores why a long time horizon is essential. SCHB adds broad diversification across thousands of U.S. companies, while SCHY brings international dividend exposure to avoid relying on one market alone. At this stage, the key behavioral rule is consistency. Rebalancing and steady contributions will matter more than trying to time the market. By midlife, the picture changes. In your 40s or 50s, you might prefer to add income and a little more stability without giving up growth entirely. A balanced mix could be 40% SCHG, 25% SCHB, 15% SCHD, 10% SCHY, and 10% SCHZ. This works out to about 90% stocks and 10% bonds, still growth-oriented but with a safer layer built in. SCHD's 3.92% dividend yield and very low expense ratio now start pulling their weight, delivering income while keeping costs lean. SCHZ, the bond sleeve, takes the edge off of volatility during market drops, while growth exposure through SCHG and SCHB continues fueling expansion. Here, the behavioral tip is to start automating dividend reinvestments and building a steady bond position, since these gradually form the backbone of long-term security. Approaching retirement, the shift prioritizes preservation and predictable income. A practical mix could be 30% SCHD, 20% SCHY, 30% SCHZ, 10% SCHB, and 10% SCHG. This brings the stock-bond balance closer to 70-30, with half the equity exposure, SCHD plus SCHY, centered on dividends. The SCHD and SCHY combination, 50% together, supplies income, while SCHZ at 30% gives a buffer of high-grade bonds to reduce volatility. A smaller allocation to SCHB and SCHG keeps some growth exposure, but the tilt is firmly toward stability. At this stage, the key behavioral advice is to test your withdrawal strategy and keep an eye on sequence of returns risk, since large losses early in retirement can disrupt even strong plans. Think of these 3 allocations as different gears on the same car. When you're young, you're accelerating with growth. In midlife, you're cruising with a mix of speed and stability. Near retirement, you slow down but stay on the road, using income and bonds to smooth the path. Each stage uses the exact same toolkit. You're not replacing funds, just shifting weight toward what matters most of the time. That's where the toolkit shows its real strength. It covers every phase of life with flexibility and simplicity. But simplicity doesn't mean perfection. Even with clear allocations and smart behavioral habits, There are risks built into each of these ETFs, risks that can catch investors off guard if they don't understand what's inside. Even with a streamlined toolkit, it's crucial to understand the hidden risks built into each fund. Simplicity makes choices easier, but it doesn't erase the real-world trade-offs. Every piece of the 5 ETF framework brings strengths, but each also carries unique vulnerabilities that can catch investors off guard. Take SCHG, the growth engine. This fund leans heavily on a handful of massive technology and innovation-driven companies. That's a recipe for strong gains when giants like these are thriving, but it leaves the portfolio exposed when they stumble. In 2022, SCHG dropped by negative 31.80%, showing exactly how quickly concentrated exposure can turn painful. For an investor depending on long-term growth, SCHG is powerful, yet recognizing its reliance on a relatively small group of firms is part of using it wisely. SCHD, by contrast, is known as a steadier, dividend-focused option. It screens for quality companies with strong fundamentals and a reliable history of paying and raising dividends. That makes it attractive, especially in turbulent markets. But being defensive also means it can lag when growth stocks dominate. During 2022, while it held up better than pure growth, SCHD still declined minus 9.47%. It reminded investors that even dividend strength doesn't act as a shield, it simply tends to soften the blow rather than eliminate it. Then there's SCHY, which expands the reach internationally. On paper, this adds diversification beyond the US, spreading risk across different markets. But foreign exposure creates fresh challenges. Currency swings can erode returns, and slower economic growth or political instability in other countries can weigh heavily. The results were clear in 2022 when SCHY fell minus 21.60%. For investors hoping international diversification would provide relief, that decline served as proof that overseas markets don't always offset domestic downturns, and they can add their own volatility to the mix. The bond side, SCHZ, is meant to act as a stabilizer. It invests across thousands of U.S. investment-grade bonds, long considered a safe cushion in portfolios. But bonds react inversely to interest rates. When rates rise, bond values fall, much like a seesaw. During the recent rising rate cycle, SCHZ delivered poor performance, including a 5-year CAGR of minus 0.97%. Investors expecting bonds to offset stock losses were surprised when both sides of the portfolio dropped in tandem, leaving them without the safety net they assumed was automatic. Looking across these examples, the lesson sharpens. Even a carefully balanced toolkit can stumble when markets align against it. In the 2022 downturn, all 4 of these ETFs posted real losses. SCHG down minus 31.80%, SCHY down minus 21.60%, SCHD down minus 9.47%, and SCHZ losing ground as rising rates pushed it negative over the 5-year span. Diversification limited the damage but didn't erase it, which is the nature of risk in any portfolio. Numbers alone, however, don't capture the toughest challenge: emotional pressure. When multiple funds fall all at once, it doesn't just test balance sheets, it tests patience. Many investors panic sold after watching both stocks and bonds slide together in 2022. The best psychological defense is to expect setbacks in advance and pre-commit to a rebalancing plan, so decisions come from preparation rather than emotion. Having that framework in place separates the investors who stay consistent from those who abandon ship at the hardest moment. Understanding these risks isn't about discouragement, it's about building confidence. By recognizing where each fund can falter, you remove the shock factor that derails so many strategies. A simple toolkit only works if you trust it through setbacks as well as rallies. Knowing both are inevitable. And with that mindset, the real power of this approach becomes clearer. It's not about hunting for the flawless fund or designing a portfolio that never stumbles. It's about choosing a framework you can stick with and repeat year after year without second-guessing every decision. Success in investing comes from keeping things clear and repeatable. The 5 ETF toolkit gives you that structure: broad coverage, low costs, and allocations that adapt as your life changes. You don't need dozens of funds or hours of research, just a focused system you can actually use. Here's your next step. If you're ready, pick the allocation that fits your age and set up a small recurring investment this week. Start moving instead of waiting. If this framework made investing feel simpler, give this video a like, drop a comment with your stage or preferred mix, and subscribe for more practical systems you can put into action.